Time is a friend of wonderful businesses and an enemy of mediocre ones. This quote by Warren Buffett, the legendary investor known as the Oracle of Omaha, holds a fundamental truth about building wealth. Patience and quality surpass any short-term strategy. But what makes Buffett so special? Why is he a role model for those seeking financial freedom? Buffett began his humble journey with nothing more than a bicycle and a newspaper, delivering mail in Omaha, Nebraska. Today, his fortune exceeds $115 billion, and his life philosophy remains a beacon for investors around the world. What does he have to teach us? He offers us 7 keys that go beyond mere investment tips. They are life principles that can transform the way you think about money, time, and success. In this guide, we will explore Buffett's 7 keys to building wealth. Each one reflects values such as discipline, patience, and strategic vision, essential traits for those seeking to build solid and lasting wealth. We will demystify the secret behind Buffett's success and, most importantly, show you how to apply these practical lessons in your life. But before we dive into the details, take a moment and ask yourself, am I willing to change my mindset to achieve my financial goals? For Buffett, wealth is the result of well-made decisions over time. It's not a stroke of luck or a race to make quick money, but the outcome of years of consistent work and tested strategies. Throughout this video, we will reveal how you can adapt these 7 keys to your reality, regardless of your starting point. Whether you are already investing or just beginning, Buffett's lessons are like an eternal guide, transcending generations. By the end, you will be better equipped to make choices that truly impact your financial freedom. Are you ready to change your life? Then stay with me, because in the next few minutes you will discover how to align your financial decisions with the mindset that built one of the greatest fortunes in history. Let's walk this path to success together. The first key, invest in yourself. Buffett is adamant, the best investment you can make is in yourself. He has always emphasized the importance of enhancing your skills and knowledge. As he once said, no one can take away what you carry within yourself. Buffett began investing in himself early. He obsessively studied the stock market and developed skills such as public speaking and persuasion by attending courses like those offered by Dale Carnegie. This ability to continuously learn was crucial to his success. To apply this key, ask yourself, am I acquiring skills that increase my value in the market? Am I investing time and money in knowledge, such as books, courses, and mentorships? For example, learning about personal finance or how to read company balance sheets can be a starting point. The more you educate yourself, the more confident and effective you become in making decisions. The second key, patience and a long-term mindset. Buffett is famous for saying that the stock market is a device for transferring money from the impatient to the patient. The second key to building wealth is developing a long-term mindset. Buffett invests in companies he believes will remain strong and profitable for decades, such as Coca-Cola and American Express. He doesn't seek quick gains, but instead focuses on building continuous value. A classic example is his investment in See's Candies, a candy company. He purchased the company in 1972 and continues to profit from it today because he believed in the quality of its products and the loyalty of its customers. To apply this key, before investing, ask yourself, if the market were to close for 10 years, would I be comfortable with this choice? Focus on building wealth over time, rather than chasing trends or quick profits. This patience also applies outside the stock market. For example, in building a business, it may take years before you reap the rewards, but those who are willing to wait inevitably stand out. The third key, buy businesses, not stocks. One of the most revolutionary concepts Buffett introduced to the world of investing is the idea that when you buy a stock, you should treat it as a stake in a real business. He evaluates stocks as though he were purchasing the entire company. This means analyzing financial health, the business model, management, and long-term potential. Buffett often uses the following analogy. If you were to buy a farm, you wouldn't check its value every day. You would look at its productivity over the years. A prime example is Buffett's investment in Berkshire Hathaway. He purchased shares in the textile company in the 1960s, not because of price fluctuations, but because he saw potential in its structure. Over the years, he transformed Berkshire into a conglomerate that controls major businesses. To apply this key, before buying a stock, study the company as a whole. What are its products? Who are its customers? Is the management competent? Ignore market noise and focus on the business's performance. Buffett avoids companies he doesn't understand or see intrinsic value in, such as speculative and highly volatile businesses. A clear example is his skepticism toward cryptocurrencies. The fourth key, sees market crises as opportunities. Buffett is a master at turning moments of crisis into golden opportunities. He believes that markets are driven by two factors, fear and greed, and those who can stay calm during times of uncertainty will come out ahead. As he says, be fearful when others are greedy, and greedy when others are fearful. A classic example is his approach during the 2008 financial crisis. While many investors panicked, Buffett made substantial investments in companies like Goldman Sachs and General Electric, taking advantage of low prices caused by widespread fear. Years later, these investments generated billions. To apply this key, during economic crises, keep a list of high-quality companies you would like to own and watch for price drops. Use crises as opportunities to buy good businesses on sale, but always based on analysis, not emotional impulses. The fifth key, invest only in businesses you understand. Buffett avoids investing in industries or businesses he doesn't fully understand. This approach is known as the circle of competence. He knows where his strengths lie and focuses his investments in those sectors. As he states, you don't have to be an expert in everything, but you need to know a lot about your area of expertise. For example, Buffett rarely invests in technology. He openly admits that he doesn't understand the business models of many tech companies, so he prefers to focus on sectors he knows well, such as consumer goods, insurance, and financial services. To apply this key, identify the sectors or types of companies you understand best and focus your efforts there. Before investing, ask yourself, if I had to explain this company to someone, could I do it? The lesson here is clear. Don't invest in something just because it's trendy. Invest in something you understand. The sixth key, evaluate undervalued companies. Buffett believes the key to successful investing is finding quality companies being sold for less than they are truly worth, what he calls a margin of safety. He uses a value-based approach, calculating how much a company should be worth based on its projected future earnings and comparing that to its current price. A famous example is his investment in Coca-Cola in the late 1980s. At the time, the company was facing temporary challenges and was undervalued. Buffett recognized that Coca-Cola's long-term growth potential outweighed its short-term problems. He invested billions, and to this day, it remains one of the greatest successes of his career. How to apply this key? Learn to evaluate companies based on solid fundamentals, such as consistent profits, cash flow, and competitive advantages. Wait for opportunities where the market underestimates a company's value and invest with confidence. Here, patience is crucial. As Buffett states, the stock market is a mechanism for transferring wealth from the impatient to the patient. The seventh key, practice discipline and consistency. The final key is the foundation that supports all the others, discipline and consistency. Buffett doesn't let himself be swayed by fads, trends, or market euphoria. He follows his strategy methodically, even when it means going against the majority. One example is his refusal to join the dot-com bubble of the late 1990s. While many investors were rushing to buy shares of internet startups, Buffett remained faithful to his philosophy. When the bubble burst, he was one of the few who didn't lose money. To apply this key, create a financial plan and follow it rigorously, even during times of high emotional pressure. Avoid impulsive decisions and periodically review your strategies to ensure they remain aligned with your goals. Buffett also applies this discipline in his personal life. He lives simply, spends little, and prioritizes quality over quantity. A valuable lesson for anyone seeking to build wealth. Now that you know Warren Buffett's 7 keys to wealth, it's time to turn knowledge into action. Let's recap the key insights and explore how to apply them practically in your daily life. Plant your tree today, and in the future, you will reap the fruits of your wise decisions. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finances and investments. Thank you for watching and see you in the next video.